stereotypes, breaking the rules. You can't tell me what is for me. Yeah. You got a lot more behind those pretty eyes, but you gotta let the world see. Yeah. So shake it out. Now is the time while you're waiting. You look good enough. Now is the time while you're waiting. What are you waiting on? Don't let them bring you down. They ain't rocking with you, so what? Yeah, you're gonna be cool without them. Don't let them bring you down. They ain't rocking with you, so what? Yeah, you're gonna be cool without them. Oh, don't let them bring you down. Don't let them bring you down. Oh.
Welcome to the Retirement Learning Lab, where we teach you how to retire without running out of money. My name is Van Richards, and this is the daily stock update for the NASDAQ. Thank you for joining us today. We have a lot of good information to cover with you today. We're going to talk about a couple of stocks from the NASDAQ, which we do every single day. And the whole idea behind this show is we're sharing with you the story of some of these different stocks. And think of it this way. Do you buy anything of significance without understanding what it's all about? Have you ever bought a car just by saying, hey, I like that car, I'm going to buy it? Or it doesn't matter whether it's a can of tuna fish or whether it's ice cream. You look at the ingredients sometime and you try to figure out what's going on with it. When we're talking about the stocks that we're going to discuss today, we're going to talk about four different things. We're going to talk about the value of those stocks. We're going to talk about the insiders and what they're doing and buying and selling with those particular stocks. We're also going to discuss the dividends, because the whole idea of this show is to help people head toward retirement and build up money for retirement. And dividends is a big deal with that. The other thing that we're going to look at is we're going to look at the morality of some of these different stocks, the ESG, environmental, social, and governance aspects, plus the BRI, which is the biblically responsible investing principles that go along with these different stocks. So let's get right into it and talk about the two companies that we're going to discuss today. The two companies that we're talking about today are Comcast and Costco. A lot of times when we talk about stocks, I may be mentioning a stock that you're not as familiar with, but I would venture to say that a lot of you are familiar with Costco and with Comcast. I've been a customer of both of them from time to time, and perhaps you have too. So let's talk a little bit more about these different stocks, but first this. As I throw the spaghetti graph up here, this gives you an idea of what happened with these two different stocks today. What happened in the stock market with these two different stocks today? Now, if you've been watching the news a little bit, you know that the market was up significantly. We saw that the NASDAQ was up significantly, and that's what we're going to benchmark these two stocks on, because these two stocks are part of the NASDAQ 100. Remember, the NASDAQ 100 are the 100 largest stocks that are in the NASDAQ. The NASDAQ is an index. Actually, it's an exchange of about 3,500 different stocks that are traded. A lot of times it's referred to as the over-the-counter exchange, but there's other over-the-counter exchanges too. This one in particular has a lot to do with technology, because there are a lot of technology stocks that's inside of this. You'll see Apple and Amazon and Facebook and Google. All of those stocks are in the NASDAQ. The NASDAQ 100, of course, are going to be the top ones. But what we're talking about today is we're talking about Costco and Comcast. So let's see how they did in comparison to what the entire market did. Of course, the market's being driven by a lot of the tech stocks top ones that I just mentioned. And if you follow my dancing cursor, you can see what happened during the day. The green line is the NASDAQ itself, and you can see that Costco is in red and Comcast is in blue. Kind of gives you an idea of what happened throughout the day. But we want to take a little bit more of a historical look on this. So let's go back 6 months and see what happened with these two different stocks and see how that they reacted to the COVID-19 crisis that started to occur in February. Follow the dancing cursor again, and it's right about here that you're seeing where things are going on. And you can see the march forward and the recovery in the economy by looking at the green line. That's going to be the NASDAQ 100. And you can also see the blue line, which is going to be Comcast. We saw in the very beginning, we're going to look individually at the graphs in a few minutes, but just this gives you a little bit of an idea of how they work together. Let's look at the individual stocks and see how they fared. First, I want to bring up this compared to the S&P 500. I threw in the gold colored line because I want to compare that to. In a few moments, when we talk about the volatility of these stocks, we're going to go back and talk about the S&P 500. So I did want to bring that into play. Now we jump right in and look at Comcast. Comcast is actually part of NBC Universal, and there's actually two shares of Comcast stock. There's Class A and Class B, and we're going to talk about the significance of those a little bit later because it has to do with the ownership. They closed out the day pretty good. They were up about 1.82%. Now, when we look at the fair market value, the valuation of these different stocks, let's hold on just 1 minute. I'm getting a message here that's telling me that I might have been kicked off Facebook real quick. So let's reconnect. Oh, gee. Okay. Hold on here, folks. We have a little bit of a dilemma. Okay, here we go. Sorry about that. I wanted to make sure that everything was working out okay. All right. Sorry about that, folks. Little electronic problem here. Now, let's go back over and we're looking at the fair market value of Comstock. At Comcast, not Comstock, Comcast. Get a little confused there. The fair market value, and this is a projection which is given by Morningstar, and they give it a 3-star rating, and they say that the fair market value is $47. The last close today was $44.20. So they're really pretty close. And you'll find out when you look at the star ratings from Morningstar, when they give a 4 or 5-star rating, it means really that the stock is underrated. If they give you a 1-star, let's take an example. Apple is a 1-star stock. Do you think that means it's bad? No, it doesn't mean that it's bad. What it means is that it's got a high value to it. It's over top of what its fair value is. And when we look at Comcast, we see that its fair value is very close to what it closed at today. The other thing that we want to discuss when we're looking at this is the continued profitability. And if you haven't joined me before, you might be looking at this and going, why the heck has Van thrown up a picture of a castle? Look around that castle. That castle has a moat going around it. That moat does what? It protects the castle. If you have in business, in stocks, if you have a wide moat, that means you have sustained profitability. This is exactly what I'm meaning. Take a look at this. The moat describes the sustained profitability of the stocks. If you have a wide moat, that means that you've got a big barrier in between you and your competition. When we're looking at Comcast, one of the biggest benefits that Comcast has going for it right now is that they are improving their technology. Now, yesterday we talked about a company called Charter Communication, which is part of Spectrum, if you're familiar with the way that Comcast is working. Spectrum is one of their competitors. That's what we want to look at. My apologies. I had a few things going on there. Got a little bit too far ahead of myself. Now, One of the reasons why that they have a wide moat is that they have increased their market share significantly. They've gone from 56% of market share up to 64% of market share. So what they're doing is they're taking business away from their competitors. They're taking business away from AT&T. They're taking business away from Charter Communications. They're taking business away from Verizon, and it's continuing to grow. So that shows you that that is one of the profitable aspects of this company, and that's why they have a wide moat that exists. Now, if we look at the actual return, let's just look at the spaghetti graph of this stock over the past 6 months. Now, you can see, follow the dancing cursor. You can look at what happened with this particular stock in between February and March when we had the coronavirus market crash, and then we proceeded pretty well from that standpoint. When we throw up this with the S&P 500, there's some really important statistics to take into consideration. When we look at the statistic that's called the beta, beta tells us how volatile this is. If you have a beta of 1, that means that basically you have the same volatility as the S&P 500. So we're really, really close here. We have a beta of 0.98%. The PE ratio is going to tell us how close we are to the actual value of the company itself. The price to earnings ratio for Comcast is at 17.6. And if we look at, let's see, what was closed today? The average PE ratio of the Standard & Poor's 500 is 29.9. Sometimes that will give you an indication as to how volatile this may be in the event that there may be a market correction. You can't take that as the gospel, because the only way to get away from market volatility is to get completely out of the market. But the PE ratio can give you also an idea of how much further that you've got to go with this particular stock. Now, remember, Morningstar said the fair market value of this stock was a 3-star. That meant that it's pretty close. There's room to grow, and you'll find out that the PE ratio has a lot to do with that. When we look in a minute at Costco, you're going to see a higher PE ratio, and you're also going to see a lower star rating. That might indicate that it's a little higher valued, and perhaps there's a little less leeway for that stock to continue to grow. If you're ready to retire, dividends are going to be something that's significant to you. Now, this is not going to be the same kind of dividends that you're getting from a bond fund. If you were getting bond fund dividends, they're more assured because of the guarantees that goes on with the bond. When you have stock dividends, they are subject to the profitability of the stocks. But when we're looking at well-developed stocks like this company, like Comcast, you can see that they have a pretty good history continuing to pay their dividends. Now, you're going to hear this from me a lot. The past performance is no guarantee of the future results. But right now, they're paying a 2.12% forward dividend. That's a good dividend for a NASDAQ type stock. But keep that in mind. One of the things that we can do for clients, and we do this quite a bit for people that are retired and they're looking for dividends, we might take the NASDAQ 100 and just put stocks into a client's account that are paying dividends so that they can continue to get dividends out. The diversification might give us maybe 70 or 80 stocks that are paying dividends, and it helps the client to continue to get some diversification and to get some income too, and to get some particular growth. But remember, this is not telling you what you should do. This is just giving you general educational information. If you want to talk more about your specific situation, then you need to contact me. We'll tell you how to do that. Well, I'll tell you right now. If you go to richardsfinancialplanning.com, you can find a time to talk to me there. Okay, let's keep going. Let's talk about Costco. Costco is an interesting company because they are continuing to grow. They're actually a retail business that's continuing to grow. When you compare it to a lot of other retail businesses, let's say, for example, JCPenney. JCPenney is going out of business. When you compare it to Costco, Costco is continuing to grow. When you look at what type of products that they're offering, it tells you a lot about the path for the future. Their profitability is coming primarily, and you're going to see this in just a moment when we talk about the moat, but you're going to find that it comes from its membership, and they have a very faithful membership. Over 90% of the people that have memberships continue to renew them with Costco. They get a great deal from their food and sundries, their fuel and pharmacy, and their fresh foods account for quite a bit of their profitability. Their hardline and softline items, hardline and softline, let me educate you on that just a little bit. Hardline items, think of it, anything that comes in a box. If it's going to be a computer or something like that, or a blender, those are hardline items. Softline items are going to be things like towels or clothes, those types of things. Those are going to be softline items. And you're going to see that those are a minor part of what is at Costco, but their profitability is coming from their overall food business in general. They had a down day, but it's not terrible in the long run. Let's take a look at what's going on from the moat standpoint. Obviously, the biggest thing they got for them is that it's a warehouse. It's a discount warehouse. Low frills shopping. That's the whole idea behind it. They have a great deal of potential for growth. And I mentioned it just a minute ago. One of the reasons that Costco has such a potential for growth is because their members are absolutely faithful. 90% of them renew their membership and keep coming back, even in the face of competition like from Amazon and from Walmart and Target and Kroger and all these other businesses that are out there. They're still getting a continuing flow based on the faithfulness of their membership. And that gives them a wide moat. And that's a big deal. Now, when we look at the fair market value of Costco, it's going to be lower than what it was in relationship to its value than what we looked at when we looked at Comcast. The fair market value that Morningstar is saying for Costco is $286 per share. Today it closed at $344.27. So you see there's a bigger disparity in between the fair market value and the close of the day. And that's one of the biggest reasons why you're going to see that this stock is only 2 stars. It's not because it's a bad company. It's because it's a little higher in value over top of its fair market value. And if you've wondered before, how does a company like Morningstar get its fair market value? They look at earnings per share, and generally speaking, before taxes and expenses and everything on the earnings per share, they take it at 15 times earnings per share. And that's what comes out to the dollar amount, their fair market value. There's a lot more math that goes into it, but that's the general description of how it works. Let's look at what's happened at Costco over the past 6 months. When we do that, it's interesting because follow the cursor right here. This is in between February and March. This is when the market went crazy, when the coronavirus really started to hit the United States. It went down, and there was problems at that time with the supply chain. So when there was problem with the supply chain, what we saw was the market was down and continuing to stay down for Costco because there wasn't a lot of assuredness as to the supply chains and how it's going to work. However, that picked back up and it continued to grow. Let's look at it along with the S&P 500, because this is really, really important if you're looking for a stock that's not as volatile as the S&P 500. If you look at the blue line, that's Costco. This is what happened with the S&P 500. In relation, the S&P 500 fell a lot more than Costco did. And when we look at the actual numbers, the beta of this is 0.68. What that's telling me is that this is about, let's say 32% less volatile than the Standard & Poor's 500. And that's a big deal. If you're looking for a stock that you want to continue to hold that's not going to be as volatile as the entire market. Now, that's just one stock. But when we look at the price to earnings ratio, it's high. And what that's telling me is that we could have higher volatility here based on the fact that the valuation of the stock is high. Now, all these are just my opinions. You have to understand that none of this is written in stone. This is just my opinion on how things are working, and I'm taking data from a lot of different sources. But if you look at the PE ratio of 41.2 and go back and compare that to the PE ratio of the S&P 500 today, which is 29.9, that tells me that the PE ratio or the overvaluation of Costco is higher. So that could add into some volatility. It's also going to tell me something in a minute when we start looking at the insiders of the company. Oh, one other really, really, really important thing, and I do want to bring this up and make it a big deal.
The beauty of your side.
If you're retired, stocks can be a good thing for you if you're looking for the dividends. Now, remember, I want to talk to you just for a real quick moment individually about this, because there are really only 3 reasons why people who are retired should be investing in stocks. And it's not for everybody, don't get me wrong, but there's only 3 reasons that people will invest in stocks. Number 1 is going to be the growth. If you are looking for long-term from now, and you might be saying, I'm retired, I don't have long-term. Well, if you're retired and you're in your 80s or 90s, you might be right. But if you're retiring and you're in your 60s, even in your 70s, you've got to be thinking what's going to be happening 10 and 20 years from now. Now, I put together a video that's over on my YouTube channel. And if you can't find it by looking on YouTube, go to my website at richardsfinancialplanning.com. If you go all the way down to the bottom, you'll see the YouTube channel link, and you can find this channel or this video that I'm going to refer to. There's a strategy for retirement that I utilize that's called bucketing. And this is the way that bucketing works. Bucketing takes segments of your retirement and then you allocate money into those buckets for the future. Now, this is what I mean. If you have year 1 through 10, you allocate a certain amount of money for that. And you don't want it as volatile because you've only got a 10-year time period. You have year 10 through 20. And did you have an amount of money that you allocate in there? That might be intermediate volatility. Then you have 20 through 30 and beyond. And that can actually be just like when you were in your 20s and you were trying to invest in the market and you're trying to get a 20-year growth. If you're retiring today, and you're in your 60s, you could be retired for 30 or 40 years. So the bucketing system will help you. And dividends can be a big part of that. But that's one of the reasons why dividends, growth. And then the third reason I tell people this is some people just like to invest in stocks. That's not a problem. I've done that for a lot of people, but I don't want to go off on that tangent too much. So let's go back over to where we were. Okay, we're talking about dividends here. Now we're going to talk about who's owning these companies, who's buying and who's selling. Now, Costco is a really interesting company because I use the who's selling on the inside of this company. Sometimes not just this company, but when I look at the sellers, I look at the executives of the company and I think if these people are selling, then maybe they know something that I need to know. Or if they're buying, maybe it's undervalued and I need to know why they're buying. That might give me an indication as to whether it would be a good buy or a good sell for a particular stock. That's not always the case. And that is exactly the case with Costco. Because when we look at the sellers here, you see a lot of red on the page. There's a lot of people who are inside the company who are selling. When I go over and I look at this, now I'm going to make this just a little bit bigger, so bear with me for just a moment. Okay, if I go over here and I look at the numbers, this is the CFO of the company. Okay, and you can see that he's selling quite a bit. He's a young guy. He's actually still selling quite a bit. These are other executives that are here too. And you might be asking yourself, wow, why are all these people selling? There must be something going on bad. No, there's not anything going on bad. Nothing. The reason they're selling is because it has a PE ratio of over 41. That's the reason why they're trying to just take some profits off of the table. Now, keep this in mind. When you're investing in stocks, the whole idea is that you have to invest through market cycles. A market cycle generally is going to be like this. You have anywhere in between. The bear market's going to last. Well, if you look at the recent bear market, it's lasted only for about 3 months. It's been the shortest one in history, but most of the time it's going to be 12 to 18 months. That's the time when the market shrinks. Then when we look at the market and it's growing, those are called bull markets. Bull markets generally last in between 3 to 4 years. Now, when we add that up, the cycle is going to be about 4 to 5 years. You need to be able to give yourself at least 4 to 5 years in market cycles to be able to take advantage of the long-term value of stocks. And that's the strategy that will help you have a better probability of success toward the future. If you're just looking at this as, I want to get into this and get out of it very short and make a profit, there's a lot of people out there that are trying to do that now. And before you do that, I want to make a recommendation to you. There is an app that's called Webull, Webull. It's like Robinhood, but I like Webull because you can get the app on your phone and you can set up a paper account, and you can set up this imaginary account, and you can trade $1 million in your imaginary account and see how it goes. Maybe it'll go good. Maybe it won't. But you can find out without wasting a penny. It's free too. But I've done one in the past. It's kind of fun. But if you're really serious about your stock investing, you want to take a little bit more methodical strategy. And that's what we're talking about here by setting up accounts where you take advantage of the market, the long cycles from that standpoint. So let's get back over and look at the ESG of these stocks. So let me add this back over to the stream and take you back over to where we are. Oh, one other thing I do want to bring up is that even though with Costco that you see some people selling, Morningstar actually gives them an exemplary stewardship rating. And that means that the company is being run well by their opinion. Okay, great. We get to the ESG attributes of stocks. This is a big deal for some people because a lot of people think they don't want to invest in companies that are doing bad things, either because they don't want to be involved in it from the standpoint of the environmental, social, and governance, or else they don't want to be involved in a company from a biblical responsible investing standpoint. We're going to talk about both of those. The graph that I've put up here for you to look at is a general listing of the 100 stocks in the NASDAQ 100. And you're going to see that there might be 3 companies that are involved in nuclear power, GMO, weapons, animal testing, gambling, alcohol, pornography. Are these companies that would bother you if you own them? If they are, then I'm going to tell you how to draw them out. You could actually own the NASDAQ 100 through a strategy called direct indexing and pull these stocks out. And I think that for some of you out there, this is a big deal. If you're not wanting these companies with these particular principles. So let's get right into it and talk about it. I use a company called MSCI to research ratings on ESG. You can find it. It's for free. It's on MSCI. Just look it up on the internet and you can find exactly what you're looking at right here. They rate Comcast as a BB company. Now, they take a general view of ESG. You might have good attributes and bad attributes, but they're trying to look at it from an average standpoint. On the other hand, if there's some characteristics of a company that you don't like, you can just draw it out if you're doing direct indexing. But if you're invested in a mutual fund or in one individual stock and you don't like it, then you can draw it out. But if you're in a mutual fund or an EFT or ETF, exchange traded fund, then you can't do much about it from that standpoint. But let's look at the inside of this company from MSCI standpoint, and it's actually Morgan Stanley. It's their international division. They're telling us that labor management is an area that they're lagging in, and that they're average in corporate governance, privacy data, and corruption and instability. They are leaders in carbon emissions. So that's a good thing to know. Now, if those are issues that are important to you, then you want to keep that in mind if you're thinking about buying Comcast. But let's look at it also from an internal standpoint. Now, this has to do with the shares of the company. Before, when I told you about the company that it had A shares, it has B shares too, but it has to do with how it's divided up in between the ownership. Remember, this company is actually owned generally by NBC Universal, but there's also an individual by the name of Brian Roberts, who is the chairman and CEO. He owns the other third of the company. Now, the interesting part is he owns the other third, not by an economic standpoint, but by a voting standpoint. He owns the B shares. And the B shares represent only about 1% financially of the company, but they represent about a third of the voting of the company. Now, you can't buy B shares. Those are only for the CEO in itself. But I thought that might be important to you. Sometimes that's something that people want to know about, so you can use that. Morningstar gives them a standard rating when it comes to their stewardship. All right. Let's look at Comcast from an insider standpoint. And it's actually pretty even. There's not a lot that you can tell about going on. If you get really, really, really close, here, I'll grow this for you just a little bit. So you can see here. You can see that in the past 3 months, there were 10 buyers and 7 sellers. In the past 6 months, there's been 50 buys and 54 sells. And when we look at the buys and sells, it's pretty even over the past 12 months too. So there's not a lot to tell from that standpoint, and it's actually been pretty even. So it's a good statistic, though, to keep in mind. Now let's get on to the BRI, and I'm going to go through this really quickly because I don't want to draw it out too long. Remember, from BRI, we're looking at the customer standpoint, the community standpoint, the workforce standpoint, and the company's world involvement. Now, when we look at the individual companies, Comcast actually gets a negative rating from Inspire. And just to let you know, the numbers that I'm using comes from a company that's called Inspire, and they do research. They actually have some fund investing strategies and investment products that are available too. But I utilize their rating services for BRI because it gives us a good understanding of what's going on. They actually give Comcast a negative 25. Now, the negative 25, look at it in this relationship. You can get anywhere in between plus 100 all the way down to negative 100. Negative 100, I don't know of any companies that are that bad, but it would not be good. But when we look at Comcast, they're giving it a negative 25. And I think that one of the biggest reasons that Comcast gets a negative 25 is because on their networks, they do have pornography that's available. And if that's something that bothers you, then this wouldn't be a stock that you want to invest in. So let's keep moving on. When we look at Costco, Costco gives actually the MSCI rating is the same as it was for Comcast. It's a double B. There's a lot more things going on, though, when we're looking at Costco. MSCI actually says that they're lagging in more areas. They're lagging in labor management, product and safety quality, supply chain labor standards, but they're also critical and give them good ratings in things like opportunities in nutrition and health, raw material sourcing, reducing the carbon footprint. And when you think of Comcast and you compare it to Costco from an ESG standpoint, they both have double B ratings. But if you were more concerned about labor management issues, maybe Costco wouldn't be a company for you. But if you think that they're doing well, then that would be your preference too. If we look at the BRI that goes along with Costco, Inspire gives them a plus 25. And that's actually a good rating. Remember that the ratings from Inspire go in between the plus 100 to minus 100. Generally, when we cross over into anything that's a plus, there's no negative attributes. They could be doing better in some issues than others, but they don't have any really glaring negative issues, as when we talked about Comcast just a few moments ago. So this brings us to the very end of today, and I want to thank all of you for listening. Remember, if you have questions, you can send them in. If you didn't get a chance to ask them today, you can put them into the platform that you're watching on, or if you want to send it to me directly, you can send it to van@richardsfinancialplanning.com. If you are interested in talking about your particular situation, then you can go to my website, richardsfinancialplanning.com. You go down and you find the teal button that's like this one right here, and you can set up a brief time where we can have a telephone conversation about your particular issue. You can ask me anything you want to about investments. It's free, doesn't cost you a penny, and I'm glad to spend the time to talk to you. Okay, other than that, I want to thank you for joining me today. And we've got more coming up tomorrow. Just to let you know, tomorrow, it'll all depend upon that big old Hurricane Laura that's out there in the Gulf of Mexico and how it affects us here in Houston. So I plan on being on the air at 5 o'clock, but we'll see how it goes from that standpoint. Thank you a whole lot for listening, and stand by just for a moment because you have a disclosure that's important for you to know about this broadcast. So we'll do that. Y'all have a great day and stay safe this evening.